Good afternoon, everyone. Welcome. I'm Zander Heinen, president of FinLink. Today, we're going to dive into one of the most important strategic issues facing advisory firms, mergers, acquisitions, internal succession, and the capital solutions that make those transitions possible. We all know the headline statistics. Roughly 1/3 of advisors are expected to retire in the next decade. At the same time, a significant percentage still don't have defined succession plans. Uh, According to our customer base, there's about 12,000 advisors on FinLink that do not have succession plans currently. That creates both risk and opportunity in today's market. Before we jump in, I want to briefly share a quick update from FinLink. We recently announced a strategic partnership with Rafa AI to transform FinLink into an AI native platform focused on measurable business outcomes. What that means in practical terms is this. Instead of simply connecting advisors to potential partners, our system will now intelligently evaluate firm profiles, goals, valuation drivers, growth metrics, and succession timelines, and surface high probability matches and transition opportunities. As we talk today about valuation, deal structure, and financing readiness, it's clear that preparation and data transparency are becoming critical. Our partnership with Rafa AI is designed to help advisors position themselves proactively, not reactively, in the evolving M&A landscape. With that, I'm excited to welcome Greg Prokott from Advisor Financing. Greg, thanks for joining today.
Happy to. Thank you, Zander. Good morning, good afternoon to all of you, depending on where you're at from a time zone standpoint. What I'd like to do for you today is share a little bit about myself and how and why I wound up being here today. Talk to you a little bit about our firm and how we can add value to your practices. And we want to discuss the opportunity that's available in front of you and how you can potentially capitalize it. I know valuation of practices is a hot button for a lot of advisors, and we want to see where we're at from a present status, where we're at snapshot in time. As well as the evolution of the acquisition financing space and what banks are looking for. And then we'll get down into some real world examples. And so how's that sound to you, Zander? Should we go ahead with that?
Yeah, that sounds amazing.
Wonderful. So again, introducing myself, my name again is Greg Prokott. I've got over 30 years in financial services, 20 of that as a wholesaler. So I speak fluent financial advisor. And I know that many advisors measure us wholesalers in dog years. So I did that for about 140 years, and that was quite enough of that. But most wholesalers are trying to determine what they do when they grow up. And I feel very fortunate to have found this niche where I get to continue to engage with financial advisors because it's in my DNA and we're having a really good time here. And so enough about me, tell you a little bit about our firm. So the genesis of advisor financing is our founder is a gentleman by the name of Troy Weingarner, and he happens to be a financial advisor. And about 9 years ago, he went to the marketplace to the usual suspects to try to find capital to facilitate his own partial purchase of his own senior partner's practice. And he found that to be a mind-numbingly frustrating experience. And so he thought there's got to be a better way. So he built our company. So we are a firm that provides capital to financial advisors built by financial advisors. Now, our claim or our elevator speech, as you would, is that we are the low-cost provider of capital to financial advisors that are engaging in practice acquisitions, internal transitions, and the refinancing of that debt. And the reason we are able to make that claim is twofold. Virtual, first of all, we were virtual before virtual was in vogue. And the second reason is that it kind of is a function of our origin in that I'd mentioned to you that Troy's got a day job. He's a financial advisor. His office is paid for. I work from the old wholesaling model where I work out of my home. You're looking at my office as we speak, as do my other colleagues. So our overhead is virtually nil. And so we are generally 50 to 200 basis points below most others that are in this space. I'll also mention to you that what you probably already realize is this doesn't fit in the historic banking model because there is no building, there's no equipment, there's no airplane to put up as collateral. It's purely cash flow borrowing, which most banks are not familiar with. And you could go down the street and survey a half a dozen banks and see if they can help you out. And four of them would look at you like you got three eyeballs. One would try to jam you into an SBA product. And the last one would say, yeah, I think we could do this. And then they come back to you in a month or two and actually wouldn't be able to. So we've done the legwork for you. We've gone out, found, cultivated, trained various banking partners on why this space makes sense. And so those partnerships are very important to us. But in the end, we are your advocate. It's my job to find you the best package that's available in the marketplace. So that's the function that we take on. That's us in a nutshell. So let's discuss the opportunity that's in front of us. And Zander addressed a couple of these issues. You're well aware of the demographics in our business. The average age of a financial advisor is 58 years old, but more intriguingly, the average age of a founder is 67. And so you can see that these factoids that Zander pointed out earlier, third of advisors retiring in the next decade, the significant number of them not having an effective succession plan in place leads to a remarkable opportunity for you. Also mentioning consolidation in the marketplace, and you're also well aware of this, in that you're hearing about these stories about PE firms entering the marketplace and paying out outlandish multiples for these practices. But we're also seeing a significant amount of activity in the 20 million to 200 million practices transitioning and transacting. And so, again, that is available out there for you. So keep your eyes open, and we'll talk about potential ways to access that. One specific type of practice that I want to reference for you has been coined the fixer-upper, also known as the lifestyle practice. And you've probably all seen this, and it tends to tilt on the male end of the industry. But you got a 65-year-old advisor. He retired 5 years ago, but he forgot to tell anybody. And he goes and visits his friend in Naples, and he visits his buddy in Palm Springs, and they have their advisory meeting, and it's a good old time, and it's a tax write-off for him. And it's a wonderful lifestyle, but his GDC is going from 700K to 550K to 480K. And I would also present to you that is that advisor keeping up on the latest trends within the advisory community? Would they even know what an opportunity zone is? Are they up to date on the latest tax planning strategies? Or is it in the best interest of the client that they sunset and transition that client base over the course of time to another younger, more hungry advisor? So let's discuss how you can potentially access those. So there's a few ways. There are the online marketplaces, and a lot of you are probably familiar with those. There's SRG, FP Transitions, Skyview Partners, and they serve a very good purpose. But I would caution you against going after these too aggressively, because the process is you find yourself in a bidding situation against upwards of 50 other competing acquiring advisors. And so you submit your bid, and the feedback comes back. Congratulations, Mr. and Mrs. Advisor. You are in the top 10 of advisors have the potential to acquire this practice. But if you just sharpen your pencil a little bit, you're going to have a good shot here. And so you go back to the drawing board and you up that bid just a little bit. And the news comes back that congratulations, Mr. and Mrs. Advisor. You are amongst the final three practices that have an opportunity to purchase this practice. And if you just up that bid a little bit, you're going to have a good shot here. So you go back to the drawing board and refine that bid and take it up a notch. And finally, the email comes back and it says, congratulations, Mr. and Mrs. Advisor. You have, in fact, secured this practice. And then a 6% premium is placed on top of that. So if you won, did you, in fact, win? Shameless plug for FinLink here. I'll state that they are, in my opinion, of what I've seen, the most cost-effective method of going online and potentially finding suitors or practices that you can potentially acquire. Are you okay with me saying that, Zander?
Yeah, I appreciate that. Thanks, Greg.
Very good. Another potential method of accessing different practices would be engaging your field leadership. If you happen to have a BD affiliation, make your field leaders aware that you have the human capital, you have the processes in place, you are hungry for acquisition. They are incented to keep those assets in place in your broker dealer. And so if you've demonstrated that you are amongst the minority that are best qualified to be a landing spot for those practices, they will be more than happy to send those potential leads your direction. So that's one way of doing it. If you happen to be an RIA, engage your Schwab representative. If you're going BD to BD, if you're internal within a BD, those are always the cleanest because it's just a button push to transition clients from one individual advisor to another. Same with Schwab, going from one advisor to another, press the button, they're all in your name. Other potential opportunities are industry networking. I happen to be very active in our local FPA chapter. And you get out of it what you put into it. But there's FPA, there's NAFA, there's NAPFA. Go to a local meeting. Go in, sit down next to the person with gray hair and sincerely engage them. How and why did your practice become so successful over time? And continue to cultivate that relationship with them, and you have the potential to be their landing spot. The last one I will cite is cold calling. A lot of you originally built your businesses by cold calling. Maybe it's been a bit, but why not engage that for a potential acquisition as well? I have a young advisor friend who took a little bit different track, and he reached out to every advisory practice within a 50-mile radius of his practice. And his message was, I don't need your A and B clients. Sell me your C and D clients. I'll be happy to take them on. He was very well trained in converting those C and D clients to gems. And so it was a very good transaction for both the sellers and the acquirers. So let's talk about valuations. Again, everybody's looking to see what practices are worth these days and what the evolution of that. And I'll delineate that between the below $2 million trailing 12 months revenue and the above $2 million. And, these are soft numbers that, there's not a clear delineation here, but say it's under 2 million and over 2 million. In the under 2 million, we're generally valuing these practices on top line revenue. You don't care what their expense structure is because you're going to assimilate them into your expense complex. So top line revenue is what matters, and most specifically, recurring revenue versus non-recurring revenue. And an industry source cited that this has evolved upwards consistently over the last 10 years, almost straight line from a 2.6x to the most recent figure I saw, excuse me, is 3.2x on top line revenue because virtually all of these transactions have been successful. Now, I never say never, but up until this point, I'm not yet aware of a missed payment, much less a default on a practice acquisition. Now, the opposite is occurring from a non-transactional revenue standpoint. They've gone from 1x down to 0.8x. And I've actually heard reference on a stage that a lot of advisors are valuing this at nothing because they're like, okay, you already got paid on this deal. All I'm doing is service work. I'm not going to pay you on that. So that's as practices become more and more recurring, banks like to see that because it's a lot easier for them to model that. Now, on the over 2 million revenue, that's where the PE firms are jumping on. And you probably also heard these outlandish figures about 15x on EBITDA. And here it is about the expense structure. And they're measuring off of EBITDA because a lot of these practices largely remain intact. And so the expense structure matters. So if you're hearing these multiples on the 15x side, you got to have context. You got to have realistic expectations. There's going to be hurdles put on you to jump over for asset retention and growth. And those hurdles are not easy. You're not going to be able to walk away with a 15x check. That's just the reality of it. What's more realistic, this slide states that it's 6 to 8x, but I'd say 10x is also realistic. So if you keep it within that 6 to 10x multiple on EBITDA, you're probably realistic. And again, a lot of the entities over the 2 million figure are looking to PE firms, but there's still plenty that do not. They want to maintain their own independence. They want to have a different track. And so those are the entities that we are largely working with. Next up, give you a little history of the evolution of this space. And it's kind of new. Historically, all that advisors had available to them was some type of an earnout or a seller note, which was fine because the seller would get an annuity and they got paid. But it was kind of hard for the purchasing advisor to digest, because if I'm 65 years old, I want to sell my practice, I don't want a 10-year note. I want to get paid in a relatively short timeline. And so there's some argument as to whether Live Oak or PPC were first to this space, but Live Oak's first loan was in 2014. So that gives you a semblance for how new it is. But I think they did a huge favor to this industry by providing capital, because they allow the selling advisor to have a liquidity event, and they allow the purchasing advisor to have a much more easily digestible acquisition that is not so encumbering to their cash flow. So we've gone from the seller notes to Live Oak was largely doing SBA financing, which was fine at the time, but there's some challenges to that as well. So we do virtually all conventional financing, which has advantages from a rate standpoint, fee standpoint, and a process standpoint. So that's the evolution of the industry. Talking about being prepared, I kind of touched on this a little bit earlier, but have your processes in place, have your human capital in place. Financial advisors are largely equipped to handle 100 to 150 advisors, and not much more than that. So bring those people on board. If you're already busting at the seams, you're not ready to acquire a practice. Next up, down payments. And this is kind of an interesting metric. A lot of advisors logically assume that they're going to have to put money down on an acquisition. And actually, that has seldom been the case. And so I'll give you a little history. I'm in my 7th year of doing this. And early on, the banks were of the preference to finance about 80% of the acquisition price, but they wanted the other 20% to be a seller note, because that incented the seller to transition that practice properly. But as the banks have gotten more and more comfortable with this space over the course of time, they are fine providing 100% of the capital. And so largely we're doing 100% financing, acquiring. The underwriting and factors in the transition plan are on a later slide, so I'll go ahead and move forward on that. So what are the banks looking for? The banks determine their appetite for these deals by the health of the practice doing the acquiring, the health of the practice that is being acquired, and the health of the personal financial statement of that advisor doing the acquisition. I get feedback from advisors frequently that, well, this thing cash flows like crazy, so this should be an easy mark. But you'd be surprised what some advisors' balance sheets look like. It's like 50-year-old advisor with a 50K and a retirement plan, and that's about it. But you probably heard the expression that banks don't want to lend to you unless you don't need the money. And there's some truth to that. So I'll talk about the personal balance sheet in a second, but first I will talk about loan to value. And people are often asked, again, how much can I finance? Yes, we can finance potentially 100% of the transaction, but banks are also concerned about loan to value. So I'll do a back of the envelope calculation for you. And so let's say an advisor has 200 million AUM. Charging approximately 1% recurring revenue, virtually all recurring. So let's say that's $2 million of revenue, loosely valued at $6 million. They are going to acquire a practice that is 100 million AUM, again, 1% recurring model. So they're bringing in $1 million a year, loosely value that at $3 million. So the combined entities are worth $9 million. The borrowing advisor is borrowing $3 million. So your loan to value is 33%. That's a slam dunk. That's an easy mark. It's big fish eating small fish. Banks will generally go up to 60 to 70% of loan to value. So they're very comfortable with an acquisition like that. That said, we've done plenty of internal transitions, And essentially those are 100% loan to value because they're buying the whole practice. So those can be done as well. Reach out, see if we can facilitate that for you, but they're definitely happening. I touched on the personal balance sheet a moment ago. And a lot of advisors do have a healthy balance sheet. They have a strong qualified plan balance, which the banks like to see because it demonstrates you've been a good steward of your own capital, but they can't actually access it. So they also like to see some non-qualified assets, a bank account, a brokerage account that you can relatively easily access. But again, you're not going to have to deploy that. It's window dressing. It looks good. People ask me, well, how much do I need? That's a very subjective number. Say if you're trying to borrow, let's say 10, 20%. If you're trying to borrow $1 million, if you got 100 to 200K liquid, you're a very good candidate for an acquisition. And you want to keep the consumer debt off the balance sheet to a great extent. If you got 50, 100K in credit card debt, that's not particularly appealing to the bank. So other factors of what the bank's looking for, I'd already alluded to this: recurring versus non-recurring revenue, much easier for the bank to model that. Age distribution of the clients. Is your client base largely over 70 years old? Are they largely in required minimum distribution phase? Are you in net outflow? That's a lot less valuable than if you continue to be a rainmaker and offset those assets, leaving the firm with newer, younger, upswing client base. And experience for advisors is also important for banks. They want to see at least 5 to 10 years of experience for that acquiring advisor. And then finally, transition plans. This is where the banks and the advisors are going to want to be on the same page. It's very attractive to the bank if you've demonstrated a strong transition plan where that selling advisors are going to stay on for a period of time to properly transition that practice for you. It looks good to the bank and you're going to like that too. Another interesting phenomena, most all the transitions I've seen have been over 90%. And that's where a lot of the clawback facilities are engaged in that. Anything over 90%, the price is the price. You go under that, there's some incremental clawback proceedings. But I've actually seen a fair number of instances where it's greater than 100% retention because perhaps that selling advisor is not quite as motivated as they were at one point. And you have this new hungry advisor who's come in, has a new opportunity, and they're turning over rocks that were not necessarily originally overturned. And they have, in fact, over 100% retention experience, which is wonderful. So let's get into some real world examples here. So I got 3 case studies for you. First one being a pure acquisition. And it's, again, within the same BD, so the transition is fairly seamless. And you've got a selling advisor with 160 million AUM. Their recurring revenue or their GDC was $1 million, 90% of which was a recurring revenue model. The acquiring advisor has 300 million AUM with almost 2 million of trailing 12 months, 80% of which being advisory. So loosely put a 3x multiple on that advisory portion of it. And we arrive at a purchase price of $2.75 million. We were, in this example, able to come up with 100% of that capital to be financed by our banking partner. We did a 10-year amortization, which I mentioned earlier. These amortizations are mostly 10 years. The term of the note was 10 years, which means that rate stays constant over that timeline. We also do 5-year and 7-year terms. And we simply reset the rate to what the market is at that point if you reach that point. The collateral is a first position lien on the firm. We need life insurance assigned in the amount of the loan as well. And the seller is, in this instance, staying on for a 6 to 12 month period to smooth that transition, which is attractive to both the bank and the selling advisor. Next case, an internal transition, and you'll notice in this example that the young advisors are buying tranches of this practice, which is very common because if you're talking a senior advisor, 2 or 3 next-gen advisors, and that senior advisor has a 2 million recurring revenue, valuing that practice at about a $6 million, that is pretty onerous for a young advisor to come in and purchase the whole thing. That 6 million is probably 10 times more than what they paid for their house. So fairly intimidating for them. And so the solution that oftentimes is to allow those younger advisors to buy it in incremental measures. And so these two young advisors already have a 5% position in the company, and they want to each take on another 10% increment or tranche. So what we've done is it's 900 million AUM with a trailing 12 of 4 million. So you're talking approximately a $12 million valuation. And I'd already mentioned that both of the young advisors have 5% positions and want to up that a fair amount. So they're each taking their own $750,000 loan, 100% of which was able to be financed. And we were able to do a 10-year amortization with a 7-year term in this particular example. And the collateral for that acquisition was a pledge of that portion of the stock in the company, as well as a corporate guarantee. And so we were able to be successful to transition those 10% positions. Last example is a couple of advisors team up to take out a portion of a retiring advisor's practice. And so what they did is two different advisors are going to buy a 50% portion of the advisor that's selling, and they're expecting to transition the second portion of that about 2 to 3 years down the road. So the selling advisor is the 100% owner. He's got 115 million AUM with virtually all advisory at a 1.1 million trailing 12 month. And so the purchasing advisors are each in the range of 80 to $120 million, and they're going to jointly service those two new clients. And so they take out one loan for the amount of 1.5 million. Again, able to finance 100% portion of that acquisition, and did a 10-year amortization with a 7-year term. And the collateral, once again, first position lien on each advisor's book, and then again with a life insurance assignment and the amount of the loan. So that is the extent of my prepared comments. Here is my contact information, and I am more than happy to engage further conversations as you would feel appropriate, but also happy to open it up for questions as long as we have them. So Zander, can you go ahead and open it up for questions? And if you have any, more than happy to jump in.
Yeah. I just had one quick note on clawbacks. Two points on that. I think what was interesting that you said is, the retention or lack thereof attrition in most of these deals is very low. Mm-hmm. I think there's a bigger boogeyman out there that people think there's going to be a huge attrition once they leave. Most of the deals that I saw when I was a lender, I agree with you. I didn't see anything, worse than 90% coming over. So cool. I think that's a good thing to point out. And then I just had a question. How do you see the clawbacks, on that 90-10% provision? So are you using an escrow account for that 10% held over how long, the back end payment, when does the seller receive that? Yep. Just a little more clarity on that.
Great question. Yeah, I mean, if you pay them 100% up front, there's no opportunity for clawback, right?
Right.
And so a lot of the deals that I see, they do 80, 90% up front. We don't use escrow very often, actually. It's kind of cumbersome for the banks. It's like you have to lend the money out, and then the advisor holds it in a bank account. So they're paying the interest on that, and they're getting paid interest on their account, but they're getting, paying 7% and they're getting 2% in their bank account. Yep. So that's kind of clunky. But what banks will like to do is they'll underwrite the deal for the full amount with the expectation that they pay the secondary 10 or 20% 12 months down the road. Most of them don't want to go past 12 months because it becomes too much of an unknown. So that's generally how it's structured.
Excellent. everyone feel free to drop your questions in the Q&A box. We got a few coming in here. I guess first and foremost, will the slides be available after this webinar?
Happy to.
Okay.
Send that to you and let you distribute it.
Yeah, I will distribute it to everyone on the call. And I've also dropped in the chat the contact for Greg and his team through their resource partner page on FinLink. I got an email here from Jim. Do you do financing for RIAs as well as BD type advisors?
Absolutely. We don't do much on the wirehouse side because they're generally all owned by a bank, but everything BD oriented and RIA oriented, that's the world that we live in.
Yeah, it's the 1099 W-2 question that always pops up, right?
Yep. So I've actually got another good story for you that relates to the last question that you asked, because the concern about attrition. And I had a deal that was going on in the heat of COVID. And so obviously it was very stressful for everybody. And there was a young advisor who had previously purchased his practice from his mom and dad. And they were getting to the end of the process. And he was understandably concerned. And they're like, what is your concern? And he said that the market's going to go down 30 to 40% tomorrow and I'm going to be screwed. And their statement was, you know what we found is that when the market goes down, we actually add a lot to our client base because that's when clients figure out they need us. Yep. So they're adding clients in, couple that with the fact that portfolios are balanced. And so a 30% reduction in the market does not reflect a 30% reduction in AUM. It's probably in the neighborhood of 12% because you have alts, you have bonds, you have planning fees. And so to a great extent, this industry has been insulated from significant pullbacks. Now, I've seen 50% pullbacks over the course of my career, so I'm not saying that's not going to happen, but that's why the banks stress test this. That's why you're going to stress test this when you consider the amounts that you're going to be paying.
Great. That's a great point. Anonymous, from a valuation standpoint, how do you factor in flat fee revenue as compared to AUM?
That's a great question because, what's the definition of recurring revenue? My personal definition is if it comes in every year, it's recurring. So why would you not put a 3x multiple on that if, in fact, you're going to follow the same planning model that the selling advisor did? Now, whether a valuation entity would find that the same, I'm not positive on that, but I'd say differentiating A shares from recurring revenue makes a whole lot more sense. But that said, the A share, while banks may not be that inclined for it, I had another advisor friend who was on the forefront of this acquisition model, and he would go out and buy some dinosaur practices that had a whole bunch of A shares involved in them. And you're getting 25 basis points paying 1x on it, from the previous multiples. And he would convert them to recurring, which is worth 3x. And so if I'm doing my math right, he got a 12 bagger on those transactions. So while the bank may not be jumping up and down because they can't model that, it could turn out really nicely for you as an acquiring advisor.
Yeah, and that's a great point. And it also kind of segues to the point that you made on preparedness. As a seller, definitely be prepared. Know your book, know the worth, get a valuation, understand things like that will increase the value of your book. And then on the buyer's side, definitely have an M&A playbook, have a team in place, and be prepared with financials. We see a lot of on FinLink, we see a lot of people who just aren't all that serious. Maybe they're just kicking tires, but really you can tell the qualified buyers and the qualified sellers from the rest. So
definitely,
I thought your preparedness statement was nice, a nice touch. Do you see any loan repayment terms extending past 10 years?
Yes. In some small increments. We've done some 12-year notes, and we're aligning with some that are engaging in 15-year notes. The challenge to that is, well, Mr. and Mrs. Advisor, why do you want to do 15 years? Well, because the cash flow plays out better from that standpoint. And the bank's answer to that is, well, we don't want your cash flow to be stressed, so we want to do a 10-year. But that said, if the cash flow merits it, if your PFS and your balance sheet merits it, we can do up to 15 years.
Excellent. Have you ever seen the sale of 50% of one's practice with the original owner remaining active to both service existing clients and be a rainmaker for another 5 to 10 years? And that also includes a buy-sell option should something happen to the founder.
Absolutely. It's a beautiful strategy. There's so many advisors that almost want to die in their boots, and they're having a great time, and they are continuing to stay engaged in the industry. And so and plus they're aligned with a younger generation that keeps them young, keeps them engaged with the new elements of the industry. And so, they like going out and hunting and killing and eating it. And so they're a very valuable member of that practice. And I've heard acquiring advisors that are like, man, I love having this person here. This gentleman or this woman is very engaged and a very valuable person within our practice. So absolutely, I've heard that many times.
Excellent. On the first case study, there was a life insurance premium required.
Correct.
How much was that annually, and won't that really drive down the probability of the deal?
As far as how much annually, so we need a policy. So if it's $1 million loan, we need $1 million policy. And obviously, if you're asking about the premium, that's dependent on your age and health and so forth. As far as driving down the price, I'm not sure what you're alluding to there, but virtually every deal we do has a life insurance component. Now, there have been instances where the purchaser is uninsurable. And so we have to get outside the box and try to find some solutions to that. And it can be done, but I would guesstimate that 95+% of the deals we've done have a life insurance component to it. But also if you're a team, maybe you're the 60-year-old advisor and you're teamed up with a 40-year-old advisor making an acquisition, put the life insurance in the 40-year-old. A lot more cost effective for both of you, and you fulfilled your requirement.
On your case studies, it seems that the multiple was much closer to 1x than 2x or 3x. Was I missing something?
Yeah, I think if you'll run back through that calculation, I suppose we can go back and maybe let's do this one. Wait, the first one's probably easiest. Okay, so the selling advisor is at $1 million of revenue. Maybe you were taking a look at the acquiring advisor. So it's the selling advisor is at $1 million and the purchase price is 2.75. So it's $1 million, 90% advisory. So take 90% times 3x, it's 2.7. So it's a 3x multiple. So this next one, it's kind of hard to gyrate this, but you're talking $4 million, say it's worth $12 million. They're buying 10% each. In this instance, they're getting a pretty significant discount to the practice because what I suspect happened here is the selling advisor or the senior advisor is giving them a sweat equity discount because of the hard work that they did, and they were largely contributing to that 900 million AUM. And so it's like, you know what, if I was selling this outside of the practice, I would be asking for a lot more, but I cultivated you. We're a team. I believe in you. You're getting this at a discount.
A strong proponent of that, by the way. I love that when there's sweat equity involved in these deals.
Absolutely.
Life-changing for the
yeah, it demonstrates that the selling advisor is looking out for the client, because I've seen plenty of instances where they're like, yep, too bad, so sad, we're selling outside because I get more. Which is, I mean, everybody has the right to sell how they want to, but I think internal transitions tend to have some real happy endings, generally speaking. This one, okay, trailing 12 of $1.1 million. So 3x on that, worth 3.3 million. They're buying 50% of it for 1.5. So again, this is a 3x multiple.
Great. If you sold 25% of your revenue to private equity, can you still sell your practice based on EBITDA?
Well, I mean, you can sell based on what other metric that you have agreed to with the seller. Now, as far as if you have it sounds like you're alluding to some of these private equities come in and will do minority non-controlling interest
Yep.
which I think it makes a lot of sense. It's an opportunity to pull some chips off the table. But how liquid the practice is after that's a little bit harder to determine. I'm not sure how those deals actually work.
Yep. Do you see demand in the market for smaller RIA practices? Example, 25 million AUM with founder willing to sell and stay W-2 for 3 to 5 more years? I can
Absolutely.
answer. I can answer that. Yeah, we see a lot
Yeah,
of that. Yeah, that's kind of our sweet spot at FinLink.
totally agree. Yeah, I mean, and I've heard reference to this. So, David Grouse Sr. is one of the forefathers of transition planning, and he wrote the book Acquisition Financing for Financial Advisors, which was written in 2014. So it's a little bit dated, but the general principles are largely in place. And he made the statement in one of the first couple of pages that the ratio of buyers to sellers is 30 to 1. And I've also talked to some field leaders that state that now that's an over stated multiple, and that if you ask an advisor, every single one of them says, yeah, I want to acquire, I'm going to acquire. And then you go to them with an actual practice in hand, and it's like, oh, it's summertime and I don't know if I got the human resources capital in place to do it, and maybe in 6 months. But I'd still say that it's at least 12 to 1. And I kind of alluded to these other marketplaces, and they're stating that they're actually seeing 50 bidders for these practices. So if you've got 25 million in place, it would be pretty easy to find somebody that's hungry for that. And particularly if you're willing to stay on. And, again, the beauty is you get to decide where you go. And so you'd only affiliate with somebody that welcomes you to stay within the practice.
Right. Yeah, I think David Grau Jr. SRG, they are saying it's something around 88 buyers for every seller now.
Wow.
And I think that everybody wants to buy,
Yeah.
but really to be a qualified buyer, to have your financials in order, and to know the process of an acquisition, and the financing and all that, that number looks more like 15 to 1. So yeah,
Okay.
that's what I would agree that it's higher than 30, definitely.
Okay. Interesting. Yeah. So that validates what we're talking about.
Any more questions here while we have Greg? Otherwise we can wrap it up, but I had one additional question maybe to end with. If you were advising a 58-year-old advisor today who hasn't started planning their transition, what would you tell them to prioritize in the next 3 years?
I'd say get your processes in place. There's ample numbers of places to find young advisors. When I first came into the industry, it was Texas A&M and Mankato State were virtually the only colleges that really had a financial planning program in place. And I honestly don't have no idea how many colleges there are now, but there's a very good number. And so they come in with qualifications to be the CFP. The only thing they're lacking is the time and service. And so there's a wealth of younger advisors that are hungry, that you can plug into. It certainly makes sense to also try to pilfer somebody else's. There's plenty of job postings out there where you can get somebody with a 5-year experience in place, and maybe they've got 10, 20, 30 million AUM, and they come in and pay for themselves immediately. So there's clearly a lot of appeal to that. But it's, cultural fit. Does their practice match what you've done over the course of time, or potentially, allow them to keep you young as well and show some of the evolution within the industry, and, have an open mind that if they have some ideas or strategies that seem innovative, incorporating more AI into the practice or something of that nature, it's kind of fun. I happen to, my colleagues are 26 and 32, and they're the ones kind of keeping things fresh for us. And we all play well in the sandbox together. We're all in the same role, but we don't have geographic delineations, but we cooperate, and they keep me young. So I would say it's a good idea for you to do the same in your practice.
Yeah, and that leads me to a shameless plug on the FinLink side. I don't know if you've seen it. but it's going to evolve within the next 30 to 60, 90 days, I guess, into something much different. But we have a jobs board, jobs posting. We brought on a team of young guys from Yale who are going to flip job boards on their heads, we think, with some of their matching algorithms and predictive modeling. So, feel free to take a look at the FinLink jobs posting. There's lots of young folks who are looking for the right fit. And I just want to say that, again, fit is everything. I think that's a really good point you made there. Well, with that, it doesn't look like we have any more questions, but I wanted to really thank you, Greg. Love these combos we have. It's nice to hear updates from lending partners, as I don't get to hear it all that often any longer. But thanks so much.
Thank you, Zander. Greatly appreciate the invitation and happy to interact with anybody that wants to take this conversation offline.
Excellent. Well, thanks, everyone. Have a great day, and hope to see you soon. Bye-bye.
Take care.